Welcome back to Investing Talk Podcast.
Today we're looking at Palantir.
Yeah.
And I have to say, this isn't just about government contracts anymore. It is about a massive shift in how the company actually makes money.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
Right. So let's set the stage here. It is February 2026. The dust has just settled on their Q4 2025 numbers. And honestly, they are turning heads in a major way.
They might be turning heads, but I'm looking at the chart and my head is spinning for a totally different reason.
Oh, yeah. The price action.
Yeah, I mean, we saw this stock hit huge highs in 2025. We were talking a peak of $177.60. Everyone felt like a genius back then.
They really did.
But recently it has just tanked. We are down 27%. So the main question on everyone's mind is pretty simple. Is this a falling knife that is going to hurt you if you try to catch it, or is it a golden opportunity?
That is exactly the mission for today. We need to figure out if the fundamentals actually support the hype, or if these sell-off fears we keep hearing about are totally justified.
Okay, well, let's initiate the deep dive into the numbers. You mentioned a shift in how they make money, so walk us through those Q4 results.
Gladly. Because the numbers aren't just good, they are honestly staggering. In the fourth quarter of 2025 alone, revenue hit $1.41 billion.
Wow.
Yeah, and that is a massive 70% year-over-year increase.
Wait, let me just contextualize that.
70%.
For a company of this size, that is tech startup speed. That is not usually what you see from a mature enterprise software business.
Exactly. And if you zoom out to the full year 2025 context, total revenue reached $4.48 billion.
That is massive.
It is. But here's the jaw-dropper stat. The growth engine isn't just the government anymore.
Right, because the old argument was always that they are just a government contractor.
Exactly. But U.S. commercial revenue grew 137% year-over-year in Q4.
137%. So the private sector side is just exploding.
Absolutely exploding. The government stability is still there, of course. U.S. government revenue is still strong, up 66% to $570 million. But the U.S. commercial side is the new rocket fuel.
Okay, that is a massive pivot. But you know, markets are forward-looking. We can't just drive looking in the rearview mirror. What are they telling us about 2026?
This is where the guidance gets crazy. For fiscal year 2026, they project revenue between $7.18 billion and $7.198 billion.
Let me do some quick math on that. So from 4.48 to roughly 7.19, that is about 61% growth projected for the full year.
Spot on. And specifically for that U.S. commercial expectation, they see it exceeding $3.14 billion. That is 115% growth.
So they're effectively doubling that commercial business again.
Yes. And looking at the immediate Q1 2026 outlook, they expect revenue of $1.53 billion, which is a 74% growth rate.
So the momentum is not slowing down at all. But what about the bottom line? With that kind of hypergrowth, I usually expect to see a bonfire of cash burning in the background. Are they losing money to acquire these customers?
Not at all. Analysts are actually modeling 2026 earnings per share at 56 cents. Margins are expanding due to operational leverage.
Break that down for the listener. Operational leverage in this software context.
Sure, it basically means it costs them a ton of money to build the software initially, but once it is built, selling it to the next client costs almost nothing. So as they add more revenue, their costs do not go up at the same rate. Every new dollar drops right to the bottom line.
Okay, so the growth is there and they are profitable. But what about the competitive moat? Why can't someone else just come in and do this cheaper?
That comes down to their proprietary data integration layer. They call it the ontology.
The ontology.
Yeah, this sounds like a sci-fi movie concept, but it is incredibly powerful.
How does it actually work in practice?
Think of it as a digital twin of an entire organization. It connects all the siloed data finance, supply chain, HR into one cohesive decision-making brain.
So it connects the dots that usually don't talk to each other.
Exactly. And why it matters is that it creates incredibly high switching costs. Once an enterprise integrates their data into the ontology, it is very hard to leave. If you rip it out, you are essentially paralyzing your company's operations.
Oh, I see. It is super sticky.
Very sticky. And this protects their market share against competitors like Big Bear or UiPath. They don't just automate tasks. They position themselves as the AI orchestration leader.
The conductor of the whole system.
Precisely.
Let's check the balance sheet then. Financial health check. Do they have the war chest to keep this up?
They absolutely do. significant cash reserves, and minimal debt.
That is always good to hear. What about cash flow?
FY 2026 free cash flow is poised to accelerate.
Okay, but are they prioritizing any kind of return to shareholders? Dividends or buybacks?
No capital allocation is entirely focused on reinvestment. They are prioritizing reinvestment in AI platforms over dividends or buybacks.
Which makes sense. If you are growing commercial revenue at 115%, you feed that machine.
Exactly. You don't take cash out to pay a dividend when you have that kind of return on investment.
Fair point. But let's pivot to the charts and look at the price action, because you just laid out this incredible fundamental story, but the stock chart is an absolute disaster.
It is definitely a tale of two different realities right now.
Let's recap the price history. Like I said, in 2025, the share price rose over 100%, peaking at that $177.60 mark by year-end.
Right, it was a massive run.
But the current reality is a sharp 27% monthly plunge. I'm looking at the moving averages, and it is ugly. The stock has broken below the 20, 50, 100, and 200-day simple moving averages.
Breaking that 200-day is a major technical breakdown.
It is the ultimate line in the sand for traders, and the momentum indicators confirm it. The RSI, or Relative Strength Index, is hovering around 38.
So it is approaching oversold levels.
Yeah, usually under 30 is oversold, so it is getting close. And the ADX, the average directional index, is around 30. That means the downward trend is actually quite strong.
The charts definitely paint a grim picture.
They scream sell. Or at least stay away. So why would anyone want to touch this right now?
I get the technical gloom, but we have to look at institutional flow. Despite this broader sauce sell-off, there is actually evidence of accumulation going on behind the scenes.
You mean the big funds are buying the dip?
Yes. You have the psychological momentum from those huge Q4 beats we just talked about, and on top of that, a recent $1 billion government deal.
$1 billion. That is a huge contract.
It is massive. So the setup is fascinating. The charts look ugly, but the news flow implies a potential breakout on these AI catalysts.
Well, now let's see what the market and the big players are actually feeling. Let's talk about sentiment.
This is where the big money battle gets really interesting. On the bullish side, you have Israel Englander.
A legendary investor.
Yeah.
What is his play here?
He actually sold NVIDIA stock to buy Palantir.
Wait, he dumped NVIDIA for this?
He did. And that signals major cluster buying and institutional confidence. It is a big bet on software over hardware.
But there is always a bear, right? Who is taking the other side of that trade?
Michael Burry.
Yeah.
He made a pretty dire prediction regarding the whole software sector, which is definitely contributing to the volatility we are seeing.
Burry is always predicting the sky is falling, but he is right just often enough to make people nervous.
Exactly. And you see this battle playing out in the financial headlines too.
Give me some examples.
On one hand, you have headlines like, is Palantir a buy, sell, or hold in 2026? Which really reflects the neutral sentiment due to the recent sell-off.
Very middle of the road.
Right. But then right next to it, you'll see Palantir landed its next $1 billion deal, which is incredibly bullish.
What are the actual analysts doing, though? The guys writing the research reports.
They are surprisingly optimistic. Citi upgraded it to buy with a price target of $235 for 2026.
235. That is a massive upside from where it sits after this 27% drop.
It is. Northland has an outperform rating with a price target of 190. And Phillip Capital is also at a buy with a price target of 190.
So if you average that out, the consensus is a moderate buy with an average price target of roughly $191.25.
Correct, which offers roughly 45% upside from current levels.
45% is a lot of room to run. Are there any other catalysts brewing in the background?
There's some interesting speculation right now. We need to do a quick rumor check.
I love a good rumor. What is the word on the street?
There are whispers about potential defense contract gains if Anthropic ends up losing a $200 million DoD deal. Palantir is perfectly positioned to scoop that up.
Oh, that would be a nice little addition to the revenue sheet.
Definitely. So the overall mood, I would say, is mildly bullish. The deal wins and insider buying are offsetting the noise of the sell-off.
That makes sense. But we have to execute a deep dive into the risks. What could go wrong here? Because there is always a bear case.
Of course. Risk number one is the sauce sell-off and those bubble fears.
Yeah.
The 27% pullback isn't just random.
Right. It stems from valuation fears and warnings from investors like Burry.
Exactly. The risk is that the AI bubble pops and it takes Palantir down with it, regardless of how good their earnings are. If the market stops paying a premium for software, everything drops.
A rising tide lifts all boats, but a drain pulls them all down. What about risk number two? Competition.
Yes, intensifying rivalry from specialized AI firms. Like the question is, can they maintain their lead against cheaper, lighter alternatives?
Because you mentioned BigBear.ai and UiPath earlier. If I am a mid-sized company, maybe I don't need the whole expensive ontology. Maybe I just want a cheap automation tool.
That is the argument. But my rebuttal to that is, these risks are totally manageable via the guidance.
Huh.
The ontology moat and the sheer speed of the U.S. commercial growth, 115% growth. That provides a buffer that other SaaS companies just don't have.
So they are growing so fast that even if they lose a few budget-conscious clients, it doesn't even dent the armor.
Precisely. And that Q1 2026 revenue expectation of $1.53 billion suggests demand is not slowing down at all. The cheaper alternatives are not eating into their core enterprise market.
The numbers definitely speak for themselves there. So where does that leave us? It is time for the verdict. Let's weigh the good and the bad.
Let's do it. When you look at the whole picture, the bullish score comes out to an 8 out of 10.
8 out of 10. That is really solid, especially considering how ugly the chart looks right now.
It is. But the investment thesis is clear. Strong fundamentals and massive guidance like that 61% growth for FY26 completely outweigh the sentiment noise and the technical breakdown.
So the business is thriving even if the stock is struggling. Give me the elevator pitch for why someone should care right now.
Here is the pitch. Palantir dominates AI orchestration. They completely crushed Q4 2025. They have a $1 billion government win, and they are seeing a 115% surge in U.S. commercial revenue.
That is a tough resume to argue with. So what is the catalyst calendar looking like? What should people be watching for?
You want to watch for Q1 2026 earnings in late April or early May. That is the next big proving ground. Also keep an eye on industry conferences on AI orchestration for any new product announcements.
And what is the time horizon on a play like this?
This is a multi-year hold into FY26 earnings. The target is to ride the recovery back toward those analyst targets of $190 to $235.
Buy the dip and hold on for the ride, basically.
Exactly. Let the fundamentals catch up to the price action.
I think that is a really comprehensive look at the situation. It really shows why you can't just look at a red chart and assume the company is failing.
You really have to dig into the actual business performance.
Well, that is it for today. Don't forget to subscribe, like, and comment to this video to support the show. We will see you next time.